Why inflation is not transitory and how to beat it. Now, inflation is running hot in economies all over the world. While central banks tell us they've been struggling to get the inflation they want, per their own numbers just released, we're many times over what their intended targets are. And while we've seen prices on pretty much everything shooting higher, the Federal Reserve and other central banks, along with the media, assure us that this inflation is what they call transitory and that it will go away soon. But in this video, I'm going to show you why inflation is not transitory, what it's actually doing to your money, your wealth, and your purchasing power. I'm going to explain what you have to do to beat this inflation and some of the best ways to do this. So let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss, and I make these videos to change the way you think about money because almost everything that you've learned is wrong. And sometimes we just have to change our perspective, just get a different paradigm shift, as we'll call it. But we're looking at what the Federal Reserve and, of course, the Central Bank of the United States, the Central Bank of the world are all doing. And we're talking about, is inflation transitory? Well, let's take a look at a couple things. So we can see that the US dollar supply, the supply of dollars around the world, increased by about 24%. We can see that by looking at the base monetary supply. This is from the Fed, this is from the Fed chart. We can see the monetary supply from 1950 and 1960 just barely increased at all. 2008, it increased, or 2008 here, it increased quite a bit, but nothing compared to what it's like right now. And so from pre-pandemic levels here up to where we're at, that increased the base monetary supply, or what we would call here the monetary base, increased by about 24%. Now, when you increase the money supply, we have more money chasing the same amount of goods and services, or in this case, even less goods and services because of supply chain restraints. So more money chasing less goods and services. What do you expect is going to happen? We're going to see prices going up. Now, the money supply went up by 24%, and home prices went up, you guessed it, 24%. Now, it doesn't affect everything evenly, so some things will go up more, some things will go up less, but homes went up exactly 24%. We can see that used car prices here went up 30%, so a little bit more. But some things went up even way more, like the price of lumber, I'm sure you've heard about, went up by 300%. So yeah, what do you think happens? We raise the price, raise the monetary supply, chasing more goods and services, prices go up a little bit unevenly. But let me give you an example of what this means. This is the paradigm shift. So if they're increasing the money supply by 24%, they tell us inflation's 5%. As I just showed you, across, depends on what you're buying, homes are up 25%. If they're increasing the money supply by 25% and we're seeing a rate of 25% inflation, what does that mean? Well, a $100,000 home, if we sustain 24% inflation for 4 years, would cost $244,000. Now, that may seem absurd, but I'm sure many of you have seen your home prices double in just the last couple years. Right? So that's what that means. What it also means is that your $100,000 is losing value. It takes more and more dollars to buy those homes. It's not that prices are just going higher, it's that it takes more dollars to buy those things. So the $100,000 you have in your bank today, you decide not to buy the house, you put it in the bank for 4 years, you can't buy a house anymore. Now houses are $244,000. That's what that means. Now, is this transitory is one of the questions that we're looking at, and then we'll look at how we beat that. Is this transitory? Well, like I said, they tell us that there's supply chain constraints, which of course there is. Off Los Angeles and Southern California, there's like 50 ships that are coming over from China that can't get unloaded. They're just sitting out there. That causes supply chain restraints. There's not enough supplies hitting the market, so of course prices start shooting higher. Of course, we have worker shortages that are leading into that. However, don't buy into that narrative. What I want to say is that inflation is always a monetary phenomenon. We can see one of my favorite economists of all times here tells us that inflation is always and everywhere a monetary phenomenon. Milton Friedman said that. And the reason why is because exactly what I said. When you have more money chasing the same amount of goods and services or less goods and services, the prices go up. It's a monetary phenomenon. By increasing the money supply, it says that inflation is used to be synonymous with monetary growth, what I showed you, the base monetary supply growing. He says now it means a rise in the price level. So they've sort of changed that. Now inflation is prices, the CPI, Consumer Price Index, but really it's the monetary base expansion, what it used to be, and that's why it is a an experiment, always a phenomenon. Now, I want to show you a couple things. Now, could we continue on with 24% monetary expansion? It's a good question. Or will it stop? Will we go back to zero monetary expansion? Let me show you a couple things. So first of all, the government has about 300% debt. Look at this, from 1950 was pretty much flatline and went up in the 80s, of course, after we got off the gold standard, went up again in 2008, and look at where we're at right here. So I'll ask the question again, do you think we're going to need to continue to expand the money supply? Is it transitory? Well, the largest asset manager in the world, BlackRock, their CEO Larry Fink, says that he does not see inflation as transitory. He says, no, it is not transitory. We are here to stay. Now, I know that 24% sounds ridiculous, and especially could we sustain that over 4 years? I've laid out some of the proof, but let me show you it's not just a problem in the United States. So we have right here, this is Argentina. We can see since 2000, the rate of inflation. This is 60% inflation. 60%. Right now, we're at about 50% inflation per year. Per year, 50%. We can see Lebanon, another country. Here's 2017, inflation had stayed pretty much flat, and then boom, popped up to over 150% inflation in a single year. And now it's come back down all the way down to only 100% inflation per year, which means prices are doubling every single year, to put that into perspective. And of course, like I said, just because prices are rising doesn't mean it's all even. So we can see that Lebanese inflation hits record highs as food prices go up by 400%. So while they're seeing 100% inflation across the economy, the entire economy, food prices are up 400%. So that means a steak that used to cost $10 costs $40 at the end of the year. Your dollars are losing purchasing power. Of course, we can look at the best example of inflation that we have, which is Venezuela. And this is basically month by month by month. We're averaging over 2,000, almost 3,000% inflation. So can it happen? Yes, it can happen. As a matter of fact, it is happening. All right, now, the one thing you have to understand is this number, the hurdle rate. Typically, it's about businesses that are borrowing a carry rate, but we're going to apply it to your and I finances, how we survive. So we have to have assets, and our assets have to beat the rate of inflation. So what does that mean? That means that if things are inflating by 24%, if we're losing 24% of our purchasing power, then our assets have to be going up at least that much just to be running in place like this guy on the treadmill. All right? That's just to stand still, 24%. The problem is that the S&P 500 and the NASDAQ have only done about 20% year to date. So if I was keeping up with the S&P index or the NASDAQ index, I'm losing money. Now, what about real estate? Is real estate a good way to beat inflation? Well, I just showed you it went up the exact amount of the monetary expansion. So those are doing a pretty good job of giving you a treadmill to run on, but are they actively beating inflation? In order to do that, you need some big movers. You need to go much more than 25%. You need some 100% winners, some 1,000% winners in your portfolio, what we call asymmetric opportunities. That means there's way more upside than downside. Now, the best place that I like to look for those right now, of course, Bitcoin, cryptocurrencies. I talk about that quite a bit, and also in commodities. I've continued to talk about as they continue to print unlimited amounts of fake fiat currency, it's going to continue to push people to go buy real, hard, tangible things, commodities, and that is a place that is blowing up right now. So we want to look at hedging for inflation, protecting us against inflation, but then even more importantly, we need to be beating inflation. We want our money to grow. We want our money to buy us more goods and services in the future, not less, at least if you hope to retire one day. So we can hedge against inflation. Of course, the best way to do that has been gold. Gold has been the best, gold and silver has been the best inflation hedge, but it's kind of just kept up with inflation. So it's prevented us from losing all our purchasing power. It's keeping up with the rate of inflation, but is it beating it? Now, most analysts that study gold and silver, including myself, think that we could see gold get to $2,500 an ounce, silver get to $50 an ounce, which would be a great gain from here. I mean, we're at about 1,800 gold, so from 1,800 gold to 2,500, or silver could double potentially, and that's pretty good. That's real good if we could double our money in silver. But again, is that just keeping up with the rate of inflation? The way that we can really do it is through minor stocks that could go 10x from here. And the reason why is because they have leverage over the metal. So let me give you an example. If gold goes up to 2,500 an ounce, that is $700 an ounce of gain. But if I'm a gold mining company that has 100 million ounces of gold or silver in the ground, and it goes up by $700, that's $700 times 100 million ounces. And we're starting to see that. Now, how has it been as an inflation hedge? So this is a pretty good chart right here. This is the Fed balance sheet to gold's price. And so we can see that the balance sheet and gold's price tracked pretty well till about here. This is the 2008 financial crash. So the balance sheet shot up, and then gold kind of lagged and caught up afterwards. So it got ahead, the balance sheet got a little bit of ahead, but then gold finally caught up right here. And look what we see here. Again, the Fed balance sheet has gotten way above the price of gold, and there's a lag here, right? There's a lagging indicator. So at what point does the gold price catch up right here? Keeping up with inflation or beating inflation. The other thing that we can look at is we look at inflation adjusted. I've shown you this chart before. So this is the 10-year treasury, what would be considered a risk-free trade. I can park it in the treasury. It's pretty much guaranteed to pay me the interest, unless the US defaults, which is probably not going to happen. But we can see as this has trended down, we can see the price of gold works in the opposite right here. So you can see this gap growing right there. So if we want to have leverage over the gold and silver play, we do that through miners. Of course, like any other business, we need to find the ones that are good operators, that are managing their capital property, that have good assets in the ground. And so we want to find the very best companies. Now the key to this is we want to plan to hold for the trend. So what does that mean? So everybody wants 100% winners or 1,000% winners, but it doesn't happen overnight. You have to get early in a trend, and you have to allow that trend to develop. The two trends that we're tracking are, one, the monetary reset. The dollar is slowly or pretty rapidly dying. All fiat currencies around the world are pretty rapidly dying. We can see this. That's what inflation is. And we can see there's a monetary reset coming. I talk about it all the time. The IMF is calling for it. Bretton Woods too. The WEF is calling for a great reset and so forth. So we want to hold for that trend to develop, the monetary reset, which is happening over these next couple of years. And also there's another big trend that's pushing silver, and that's the move to renewable and EV expansion. I believe the Biden administration came out just a couple of days ago and said by 2035, their goal is to have 50% of automobiles to be EV. It's 2% today. So that's an aggressive goal. To move everything to renewable energy, wind, solar, and to EVs is going to require massive amounts of silver, massive amounts. And so these two trends are playing out, but we need to hold for that. So I like the saying that everybody is long-term bullish until they suffer a short-term loss. Unfortunately, if you want the big wins, you're going to have to be able to stomach the volatility. And we want to make sure that we're finding silver plays that are in safe jurisdictions, because as I've laid out the case many times, over the next couple of years, the world is going to be getting crazy. The goal is to own nothing, to be happy. And if you're in some jurisdictions that are unstable, that could be a problem. Now, I want to show you one that I've been looking at, and the name of the company is Apollo Silver. Now, they're a pure play in silver in the United States, which is becoming more unstable, but is still pretty stable compared to most third world countries. Now, I do want to give you full disclaimer. I am reviewing this company on their behalf. I'm using this for illustration purposes only. I am not telling you or recommending for you to go buy this company, but it is one that I've been actively looking at, and they've asked me to review it on my channel. So full disclaimer for you on that. Use this as a learning experience. I'm not telling you to buy it. All right, now, I like this company though, because it's one of the safest and most stable jurisdictions in the world, which is great. If you get in some of these third world countries, as the economies of the world continue to deteriorate, they could nationalize it, they could take it over, they could increase massive taxes, levies, things like that. Now, pretty much anytime I'm evaluating any company, doesn't matter what industry they're in, could be gold, could be silver, could be computer chips, could be software, I want to look at the locations, the team, and the investors that are involved. Now, you've heard me talk about this. Really, this team and investors is a big deal. I've been invested into early stage companies for a long time, over a decade, probably 15 years. And what I've learned is I never want to be the smartest guy in the deal. I'm looking for the smart guys to get the deal, because if they've bought in, then they've probably done a lot of the due diligence. So I look at the team and investors. When it comes to gold and silver mines, of course, the location is also into play. And so I want to show you a couple of those things. And again, use this as a learning experience so you can go evaluate your own commodity plays if you want. Now, the first thing is the locations, all right? So when we're going into resource investing, whether that's getting lithium out of the ground or uranium out of the ground or gold and silver, you want to make sure that you're going into an area that is proven, that it already has existing existing metals in the ground. And of course, the projects here, there's two of them. One is called Calico, which is in California, in Southern California, my old state. And they have a past of being a producing mine. So there's proven reserves in the ground that have been gotten out of there. Now, California is the fourth in the US for mineral production. So California, it's a big deal. Of course, that was where the gold rush moved out to a long time ago. The good thing about California is you have massive access to the world. So you have the ports where you can ship out to the rest of the world. You also have access to clean power. California is leading the country in moving to renewable energy. You have lots of infrastructure, skilled labor, and transportation networks. You can just jump out to anywhere right from Los Angeles. And so that is one of their big projects. They have about 103 million ounces in their Waterloo project, and there's a history of production of over 20 million ounces of silver production in the Calico district. So that's one of their good areas. Now, the second one they have is in Arizona silver, which isn't too far away. The one is up here in California. The other one is right here in California. The next one is just right there on the border of Arizona and California. And they have two properties here, Waterloo and Langstree. There's about 13,000 acres. And again, they're still in that hub, right, around Los Angeles, around Las Vegas, could still get out to the ports if they need to. And what I like about this is both properties have previous work done on them. Both properties are nearby each other. And because they're so near each other, they're basically like twins. They're very similar, and so they can use the same geologists, same geological surveys for both properties. Now, I said that having the right team is one of the most important things. Well, it's always the most important thing, no matter what project I'm invested into. And so we want to look at that. We want to make sure the team has extensive experience in what they're trying to do. So if they're trying to launch a software project, have they launched a software project before? If they're trying to do a mining project, have they had success mining before? And so in this case, we want to make sure they have experience in what they're trying to do, exploration and development. And boy, do they have experience. So the chairman, Andrew Boring, he has 5 companies that have been acquired or are actively trading. So all of his past successes have big wins behind them. We can see he's the chair, he's a venture capitalist, 30 years of operational experience, executive positions with the Toronto Stock Exchange, and he's founded Prime Mining and American Lithium. So he's got experience across multiple areas of mining, but most importantly, he keeps hitting wins over and over and over. And so somebody that has that track record isn't going to go jump on a dud. They're not going to ruin their track record over that. We also have right here Tom APGOF. He's the CEO and director. He has also 30 years of experience, but he also has some really, really big names behind him, including BHP and Peregrine Diamonds. So both their team has massive experience with some of the best companies, some of the best track records out there. And it's not just the team. Again, I don't want to be the smartest investor in the deal. So who are the other investors? Well, we have investors that have lined up to get in on this, including Sprott. So Sprott is the giant in resource investing. They're the household name in this space. We have Jupiter Investments, another big one. Crescott Capital, another really big one. Big time, well-known investors are in on this deal. And that brings me a lot of comfort because, like I said, I know that they've done their diligence. They don't want to be getting into duds. So that's the way that I look at these companies. That's the way that I evaluate them. I'm not telling you to go buy this one, but if you want to go do your own research, those are the things that you should be looking at. But more importantly, what I want to tell you is that you have to beat inflation. Inflation is theft. Inflation is stealing your purchasing power from your money, and currently at the rate of about 24% per year. So you don't want to just keep up with inflation. The S&P 500 and NASDAQ's not doing that. You need to have some of these big winners. Resource investing, miners, producers, as well as cryptocurrencies are probably the best place to get those. You need some big 300, 500, 1,000% winners in your portfolio. The thing to keep in mind though is that you need to diversify your portfolio. You need to think about it in risk adjusted and position size risk. So one problem that that I see a lot of people making is putting all their money into cryptocurrencies or all their money into mining stocks because they want all their money to have those big wins. The problem is you need to think about it risk adjusted. I like to split my portfolio up. I like to go for the moonshots, the 1,000% winners. Over the last 6 years, I've had 26 of them. So I like to find those. However, I also like to keep my portfolio set up for steady growth and safety as well. So think about risk-adjusted returns when you set up your position sizes. And with that, let me ask you a question. What is your choice to beat inflation? What is your plan to beat inflation? Hopefully you have a strategy, and if so, I'd like to hear about it down below. Of course, as always, give me a thumbs up on this video if you like it. If you don't like the video, give me a thumbs down. I'm just doing my best to bring this information to you, so I hope you like it either way. But if you give me a thumbs down, at least leave me a comment and let me know why. That's what I got for you today. To your success, I'm out.